I'm going to move on to dividends. Now, dividends, again, if company decides to, oftentimes if they do have net income, they have enough retained earnings accumulated, they may reward investors by giving dividends at year end. So when it comes to dividends, there are usually three important dates. Companies, the board of directors, they will declare the amount of dividends, declare the amount in total that they're giving away to shareholders, including preferred shareholders, common shareholders. Then usually about 2 weeks later, there will be a date of record. Date of record just means they want to determine from that date, before that date, any shareholders that purchase stock before this middle date here will be receiving the dividends. Okay, and then the third, usually another 2 weeks later, that will be the payment date, so when it reaches year end. Okay, so there will be a declaration date for dividends. There will be a date of record to determine who are the shareholders that receives dividends this year. So meaning after this date, if any other shareholders purchases a stock, they will fall under the following year's bracket. Okay, they will not be receiving dividends until next year. Payment date, the day that shareholders actually receives the dividends. Okay, so cash dividends causes a decrease in both assets and equity. Cash dividends means that shareholders basically are receiving checks. So companies' perspective, they're reducing their cash, and they're also using up their retained earnings to give dividends. You know, earlier I talked about legal capital briefly. Remember the par value times the number of shares. So if a company's equity section no longer has the excess part, then if they only have the minimum, the legal capital part, they are prohibited. They could not give out additional dividends. Okay, so that's another thing. If company at the end, then well, they issue the stock is only at the face value, they don't have the premium accounts, then they can't issue additional dividends out to shareholders. That's in order to protect creditors, the people that borrow them money.